Hello everyone, a very good afternoon to all of you. I, C. Ankit Jain, on behalf of Committee of International Taxation of ICI, I would like to warmly welcome all of you to this informative and insightful webinar on US income tax overview and opportunities for professionals series 2. We are really thankful to all of you for taking the time to join us and are really excited to dive in together. First of all, I would like to express my sincere gratitude to our Honorable Chairman of the Committee, CA Sanjay Agrawal sir, to give me this opportunity to moderate this webinar. I also would like to thank IRS SP Singh sir, who is an advisor and mentor to this committee for entrusting me with this responsibility. Without further ado, I would now request our Honorable Chairman of the Committee, CA Sanjay Kumar Agrawal sir, to deliver his opening remarks and welcome address and setting the tone for this enlightening webinar. Over to you, sir.
Thank you, Ankit, C. Ankit, for moderating the today's session on US tax overview and opportunities for professionals, series 2. I'm thankful to each one of my participants for coming here and joining this particular webinar. Uh, the today's faculty we have with us CA Manish Singh ji and CA Kevin Reuser, and we have the mentor of the committee CA SP Singh, Shri SP Singh IRS, and we in office the secretariat Aparna is right now on the screen, and then Prachi we have from the institute side, from secretariat side. So friends, today's topic we have kept especially for seeking the opportunities which are abroad. Though a lot of rumors about the tax on services have been talked about in the public domain, but nevertheless, these are the temporary things. A lot of outsourcing is being done, as everybody knows it, and our other committees in the institute also are working on it. Your committee at International Tax, we are developing this course, and very soon, in next 2-3 months, we are going to bring a certificate course on US taxation. However, whenever we do any webinar, I make always a request to my speakers, and this time also I'll request them to please keep at least 15-20 minutes of the end towards end, wherein we can take the questions. Because if the questions answers are given to the participant, then real meaning will be served of delivering this particular webinar to the members at large. Friends, my vice chairman is in airport, and he is likely to join towards the end of this particular webinar. In series 1, we have tried to uh, talk about that what are the various tools, what are the softwares from where you can get, and what are the various things which are required, and what are the types of the return, etc. In series 2, the professional opportunities, etc., will be delivered, and how the world is moving towards the investment and etc. will also be discussed by the faculty. So not taking much of the time, over to Ankit.
So you are on mute.
Thank you very much, sir, for your encouraging and motivational words. Now, moving ahead, I would like to invite Sri SP Singh Sirji for giving an overview about the webinar to our participants. Sri SP Singh Sirji is a distinguished former IAS officer who served as a Director of Income Tax, International Taxation, and CIT Appeals. With over 2 decades in the revenue services and more than a decade at Deloitte India, he has been a driving force in tax treaty negotiations, transfer pricing regulations, and international tax litigations. Globally recognized as a leading transfer pricing expert and prolific author, he continues to inspire as a faculty at NADT, ICAI, and IIM Lucknow. Over to you, sir.
Thank you, Ankit. Good evening, everyone. In fact, it is my privilege to present an overview of this webinar in our continuing series on US income tax, overview and opportunities for professionals. At the outset, friends, I wish to acknowledge the vision of CA Sanjay Agrawalji, Chairman of the Committee on International Taxation, and CA Chandrasekhar Chitleji, Vice Chairman, whose leadership has enabled us to examine intricate questions of international taxation in a structured and meaningful manner. Their sustained efforts reflect the Institute's commitment to equip Indian professionals with the skill required to navigate an increasingly complex global tax landscape. The subject of this evening session is of particular significance in the present context, as has been rightly put by Sanjay. With global economic integration deepening at an unprecedented pace, Indian businesses and investors are engaging more actively with the United States, whether through the establishment of subsidiaries, participation in joint ventures, or portfolio investment in US entities. Interaction with US tax law has become both inevitable and consequential. For Indian professionals, acquiring a sophisticated understanding of this system is not merely desirable, but indispensable for delivering comprehensive advisory services that meet clients' expectations in cross-border matters. A thorough grasp of the legal and tax framework governing the establishment and operation of business entities in the United States is central to effective practice. Practitioners must be conversant with the statutory form of organization, their respective implication for liability, governance, and taxation under the Treasury regulations, and the procedural requirements such as recognition by the IRS, acquisition of tax identification numbers, and creation of an operational presence. Each of these considerations directly influences compliance obligations and long-term tax profile of the entity. Importantly, failure to appreciate these distinctions can expose clients to significant financial risks, including penalties and avoidable instances of double taxation. Friends, for Indian investors, these issues cannot be evaluated in isolation. Overseas investments are subject to the provisions of Foreign Exchange Management Act, that is FEMA, including mandatory reporting and compliance requirements. At the same time, the Income Tax Act 1961 prescribes the domestic tax consequences of outbound investments, imposes obligations relating to ownership and control of foreign entities, and interacts with the controlled foreign company, and transfer pricing rules. Accordingly, Indian professionals must be able to analyze US entity law and taxation in conjunction with Indian regulatory and tax provisions in order to provide a holistic advice. The classification of business entities under US law is of foundational importance. Entities may be fiscally transparent, where taxation occurs at the level of the owner, or taxable in their own right. This distinction has far-reaching consequences for liability, compliance burden, and potential exposure to juridical double taxation. For Indian residents, the task of reconciling these classifications with corresponding domestic rules is particularly complex, underscoring the necessity of advanced proficiency in these rules for effective cross border tax planning. A comparative perspective with Indian law further illustrates the divergence in tax treatment across jurisdictions. For Indian residents participating in US business ventures, understanding this divergence is critical as they directly affect structuring choices and long term tax outcomes. Let me repeat this one. For Indian residents participating in US business ventures, understanding these divergences means divergence between US and the Indian situation is critical as they directly affect structuring choices and long term tax outcomes. Professionals who can anticipate and address such cross border frictional play a leading role in safeguarding clients against disputes and ensuring tax efficient investment structure. The relevance of these topics for Indian professionals cannot be overstated. In today's interconnected environment, domestic practice and international taxation converge seamlessly. We are privileged this evening to be joined by CA Manjeet ji, CA Kevin ji, and CA Ankit ji, who bring deep expertise in US taxation and its interaction with Indian law. Their insights and practical experience will illuminate the complexities of entity structuring, reporting, and compliance in a cross-border setting in respect of US. I once again extend my gratitude to the leaders and staff of Committee on International Taxation and to my fellow speakers for making the session possible. I am confident that today's deliberations will enrich our collective understanding and highlight the expanding opportunities available to Indian professionals in a rapidly globalizing environment. Thank you, and I wish you all an engaging and insightful session. Over to you, Ankit.
Thank you very much, sir, for such a detailed insights and overview about the webinar. Now it's time to delve into our first session. Our distinguished speaker, CA Manish Singh ji. Ever wondered how to master the intricacies of US taxation? Meet Manit, your guide for this lecture. He is a chartered accountant with DISA and CISA certifications. Manit brings over 7 years of hands-on experience in US tax, accounting, and compliance with a sharp focus on cross-border operations between US and India. His deep knowledge of international tax compliance and business structuring makes him the perfect person to lead you through this complex subject. Manit's analytical prowess and passion for problem solving allow him to distill challenging tax regulations into clear and practical insights. Known for crafting tailored solutions, he is here to share his expertise and empower you with actionable strategies. Get ready to dive into this lecture and walk away with the tools to confidently navigate us in US taxation challenges in your professional journey. Now, I would request Manitji to please enlighten us. Over to you, sir.
Thank you, Ankit ji. Thank you very much. Thank you, Sanjay ji. Thank you, the entire managing committee. Thank you, SP sir, for giving the detailed overview to our participants today. So, as the topic suggests, we are here for understanding about the overview opportunities for professionals. And today will be majorly focusing on entity discussion. What are the types of entities? How can we choose to select which type of entity suits us, which would be a relevant type of entity for us. And apart from that, we'll also be discussing about the taxation impacts of different types of entity, which Kevin ji will guide you through. So as we are moving forward, without taking much of a time in introduction, I'll make directly onto the agenda topics for our discussion for next 40 to 45 minutes. So it's about, we are going to learn the type of business structures which are prevailing in the United States. What are the entity classification election regulation? This is fairly a new concept as we see from Indian tax laws. If we compare it from Indian tax law, we do not have such a flexibility system here where we can elect or where we can choose the classifications of an entity, how it should be taxed. For example, if I talk about just an example, if in India, if you see a limited liability partnership, though limited liability partnership by virtue of LLP Act is a corporate body. So if you go in the definition of LLP Act 2008, it says that LLP is a body corporate. But still, when you talk about the taxation of the LLP, by virtue of Income Tax Act 1961, it is not taxed as a body corporate. It is taxed as a partnership. It has mentioned that when you're talking about partnership, it includes LLP as well under Income Tax Act 1961. So this is a different treatment from the legal structure. Legal structure is a body corporate, but tax structure can be a different, which is of a partnership. And the same side, US also have these type of stuff, but they also give you the flexibility. As a taxpayer, you have a right to choose. What does it mean to be elected? For example, if I say there is an election, it means that you are exercising a right to choose depending upon the certain factors and the variables which you think are necessary to elect or to make an election. When after that, for example, if you have incorporated a company in the United States, now the second step will be coming there, and you have decided what type of taxation structure you want to choose. If it is available for you, then you have to decide that, then you have to take the PAN number, which is known as employer identification number in the US when we are talking about business entities. So there are multiple type of tax identification number. In short, these are known as TIN numbers, TINs. So EIN is one type of TIN, tax identification number. If anybody of you sitting here would have filed form W8 or form W8 Benny for your YouTuber clients or for your content developers, or might be maybe somebody who is doing something on YouTube or Google, and if you have registered on AdSense, they would have asked you a EIN number for your US corporation. A few of you or many of you would have already been helped your client on that part. How to get a bank account? Because again, when you open a US company, when you are dealing with a US client, for example, an Indian person, let us assume I come to you as a client, and now you are my US tax advisor. I'll say that I want to set up a US company. A setup is not complete till the time I cannot receive payments and I cannot make payments from that US entity. So I should have a bank account, because nothing is going to be in cash. Everything is going to be in bank. You are using debit cards, you are using ACH, you are using wires. So you should have a bank account. Till the time you don't have a bank account, technically entity is incomplete. So this is a package type of deal. Then when you are offering a service called entity incorporation service, EIN and bank account are mandatory, because without EIN you cannot apply a bank account, and without bank account you cannot be into business. So we will learn about that, how which type of bank accounts are available as an option for us. Even though we are sitting here in India, we haven't never visited United States. What can be the possibility? Various type of tax forms and filing due dates for entities. These two I'll not cover in detail because Kevin Bhai is going to cover in detail. But again, for reference point, we are just discussing here just that what are the filing due dates and what are the various types of form. And cherry on the cake is a special consideration for our Indian investors. So for example, if you are an Indian investor, you want to set up a US company, what basic laws and regulation from India side are going to come into play also? Because again, when we are dealing here as a chartered accountants, we are just not only trying to deliver expertise from US side, we are making an edge over their accountants, over their CPAs, in terms that we are also aware of Indian tax laws and US tax laws, and we can provide a holistic suggestion. For example, if I say there is a type of entity, limited liability company, LLC in the US, if it's a pure play in form of US tax law, LLC is going to be a very good suggestion for an entity opening. But as soon as you bring on an Indian investor, LLC might not be looking that much a lucrative solution. You can think of moving out to a corporation. Why? Because there are FEMA and there is Income Tax Act into place. So we'll be discussing all these things, and after that taxation session will go, and we will definitely be taking all the questions in the end. So as Sanjay said that we will sparing around 20-25 minutes for, especially for the Q&A session. So moving on to further, let us take an example. So we all are here today. So I am taking an example that you, so let us assume that, because let us assume I am the one, I am a CA. I want to be into a US outsourcing business. Now, what are the options available to me to be into US outsourcing business? I can start a sole proprietorship because I am a sole player. I can start a sole proprietorship. I can start a sole proprietorship in India. I can start a sole proprietorship in the US also. I, along with some other guy, for example, I met a very good partner. I met a very good partner, very good at execution or very good at networking. I thought that, okay, we had a discussion and we mutually agreed that, okay, let's start let us start mutually and let us start together. So what we are going to do, we can form a partnership. We can form a partnership in India. We can cumulatively follow partnership in US also. Married couple businesses and qualified joint ventures are again an option because here we are covering everything, but majorly this is for the purpose of discussion. We are not going to discuss on this part. Corporation can be a good idea. Because when we are starting US outsourcing business, technically we can start it in the form of a corporation also because there is no restriction in US to start it in form of a corporation. Here in India also there is no restriction from ICAI aspect or any other aspect that we cannot open a private limited company to start a incorporation business. So corporation is as good as private limited or public limited. For example, if I say Tesla Inc. or Alphabet Inc. Inc means corporation. And when I say Tata Consultancy Service, for example, TCS Limited, or if I say Reliance Limited, LTD and INC are one of the same thing, two different jurisdictions, so two different terminologies. And in India, we have a bifurcation of limited versus private limited, but in US, there is no bifurcation of a private INC versus a public INC. A corporation is a corporation. Then it can be a public corporation, it can be a private corporation or closely held corporation, technically known as. But that is you cannot identify by its name. You cannot know Tesla Inc. is a public listed entity or a not public listed entity by just by its name. You have to check. LLC is a hybrid type of entity. Sorry, if I also go further into detail on corporation, there is one more corporation which is known as S corporation. S corporation in itself is not available to everybody. For example, if you are focusing more on Indian aspect, technically you will not be able to open a S corporation. Why? Because S corporation must have a US resident or a citizen as a shareholder, and that to an individual person. So in an S corporation, there cannot be anybody other than an individual first, and that individual must be a US citizen or a US tax resident. So both the condition has to be cumulatively satisfied. So if there is an Indian investor who is an Indian citizen or an Indian resident, so technically the situation of becoming an S corporation gets overruled and is not available most of the time. But as a concept, we will understand it that what is an S corporation, very, very relevant if you are dealing in 100% US client. For example, if a person who has just moved to United States and has got green card, now the strategy when a person is an Indian citizen vis-a-vis the strategy when the person becomes a US citizen becomes entirely different. Before that, you would be recommending let us open C corporation. Suddenly, once a person becomes a green card holder or becomes a US permanent resident, the strategy might shift to S corporation depending upon the various aspects. Also, you have to see the balance sheets, you have to see the P&L of the last already existing entity, but you can think of making a shift there because of certain advantages there. And when I'm talking about partnerships and S corporation, there is a technical term called pass-through entity taxation. So there is a terminology which is known as pass-through entity taxation. If you compare it to India, I think you would have read about business trust, real estate investment funds, or InvIT REIT. So what they do, they transfer certain type of income directly to in the hands of shareholder, which is not taxed in the hands of the business trust or REIT InvIT. Instead, it will be taxed in the hands of the unit holders. So what does it mean? For example, if a business trust, I might be using a name of income. I might be technically wrong, but just for the sake of example, I'm using this as an example. For example, if a business trust is receiving a house property income, let us assume for the sake of simplicity, by the virtue of Indian Income Tax Act 1961, business trust will not be taxed on the house property income. Instead, the entire income will flow through to its unit holder and unit holder will pay tax on it. So this is known as flow through structure or pass through structure. That income, the entity which is into between, which is actually earning the income, is not paying the taxes, but the taxes is instead paid by the shareholder or unit holder. And if some income is taxed by, for example, if the business trust receive a dividend income and dividend income is taxed in the hands of business trust, then it is exempt in the hands of the unit holders. I think everybody is aware of this type of concept which exists in Indian income tax law. This is partial pass through, because some items are being passed through, some items are not being passed through. However, in US, partnership does not pay any taxes. S corporation does not pay any taxes. It's shareholder or partners. If it's a partnership, it is partners. If it's S corporation, it's a shareholder. So partners or shareholder will pay the taxes. So partnership can be understood concept. Okay, it can be a flow through entity. S corporation is definitely a very advantageous situation where, though you are having a corporation, a limit, for example, for Indian purposes, you can assume that you are having a private limited company, but private limited is not paying the tax. Instead, the shareholder is paying the taxes, which is a very beneficial condition because you just avoid double taxation. There is dividend tax avoided, because again, when there is only single level of taxation directly in the hands of shareholder, the concept of having first being taxed at a corporate level erodes entirely. And when you entirely eliminate the possibility of taxing an S corporation, you eliminate double taxation. And furthermore, there are some other advantages also to an S corporation, which is primarily known as self-employment taxes. So a major difference between a partnership and S corporation, both are passed through. But what is in terms of taxation, a bigger difference is that there is a concept called self-employment taxes in United States, or it is also known as, it is a replacement of tax if you are not employed. For example, if you would have been employed, you would have been occurring social security taxes and Medicare taxes, commonly known as FICA taxes, FICA taxes. So if you're not paying FICA taxes because you're not employed, but you are self-employed, then you would be paying a tax which is known as self-employment tax. The rate of tax is entirely similar. So 15.3% is the rate of FICA taxes, which is imposed on a employed individual. For example, if I am employed in United States, let us assume a company called XYZ Inc. XYZ Inc. Then XYZ Inc. and I have to cumulatively pay to the IRS a sum of 15.3% of my wages to them as FICA. If I am self-employed into the United States, let us assume I have a S corporation in the US. And if I have a S corporation in the US, if I am earning, so that earning will be known as a self-employment earning. And if that is a self-employment earning, technically there should be a self-employment tax. So sole proprietorships and partnerships are subject to self-employment tax in the hands of the partners. So technically partnership and sole proprietor is itself not going to pay any tax, but partner is going to pay the tax. Vis-a-vis when it's an S corporation, though it's a pass-through entity, though it's a self-employed income, but self-employment taxes is not applicable onto the shareholder level. So you entirely say 15.3% there also. So S corporation is a very beneficial situation. But again, so it's when you talk about S, remember it through the word small. So S means technically small corporation. However, the word S has been taken for some other reference, but you can also say that S corporation means a small corporation. So everybody is an individual shareholder. Everybody is a US citizen or a tax resident. Not more than 100 shareholders are there. They are not engaged into certain type of business such as banking, insurance. So, restricted type of thing, but a very tax advantageous situation for a shareholder level. LLCs are a hybrid tax structure. They come into between corporation and partnerships. So partnerships technically sometimes might not offer you a high level of privacy as well as high level of liability protection. However, when you talk about limited liability companies, they are 100% liability protected companies at a legal level, or if you say when you talk about the legal structure, when I was talking about the legal structure in India, LLP is the body corporate. So LLC is a separately existing entity. So whenever there is a legal challenge, for example, Mr. A had a LLC named A LLC and Mr. B took some services from A LLC. Though LLC can be a pass-through entity for income tax purposes, but for the court of law, it's a separately existing entity. A LLC will be sued, not directly A. The taxation could be the way that A is paying the taxes directly on its own income tax return, but it does not make it liable for getting sued for legal purposes. So legal structure, it's a separate structure liability is limited to the amount of the investment you have made in the LLC as a partner or as a member. So when there is a partnership, it's called partners. Owners of the corporations are called shareholders. Owners of the limited liability companies are called members. So if I own an LLC, let us assume MS LLC, so I will be considered as a member. So Manit is a member of MS LLC. On the same side, for example, if me and SP sir are partners in a partnership firm, so we will say that we are partners. If we are opening a corporation, then we will say that Manit, SP sir are shareholders of that corporation. So this is the technical terminology. There has been some different type level of taxation for farmers also. There has been some different taxation for non-profit entities. Non-profit entities are dealt separately through a tax form typically known as form 990, but application is made in form 1023. So like I'll show you the certain aspects also on Google, that how it is actually been there, how you will be able to understand and how you will be able to navigate further after this session. So sole proprietor and partnerships, again, I have written it here, but again, everybody know that sole proprietorship single. For example, if Manit is opening a sole proprietorship in US, what I have to do? I have to do nothing. It's a sole proprietorship. I just have to define a name, that my business name will be this and this, and I can directly start my business. Technically, it's an unincorporated entity, so I will not get any certificate of formation, certificate of incorporation. Technical challenge opening a sole proprietorship in US is that I will not be able to open a bank account so easily. It's practically very difficult, sometimes next to impossible, as an Indian citizen to get a bank account opened without visiting to the United States, because KYC and all those requirements are also there also. And when we are sitting outside jurisdiction, it becomes difficult as a sole proprietorship to start my own, open my own bank account and start taking money into the United States. So it's a fairly simple model. If you don't want any complication, you can just have a sole proprietorship. But again, you should have it in India when I'm talking about the holistic picture that we are talking about. When we are talking about partnership, so for example, if me and SP sir and Kevin bhai, we three come into a partnership, then what is the case? We three are partners, and then we would be doing some business activity. We would be sharing profit, losses, capitals. We will contribute capital. We will share profit, losses. We can open a partnership. Definitely, we can open a partnership. Is a partnership registered entity? Definitely, a partnership is a registered entity. And here, I would also like to focus on one aspect, which I would like to everybody to be here to hear very closely. That in US, partnerships, S corp, C corp, these are not centrally managed structure. For example, in India, when I say you want to open a corporate, a private limited company, where will you go? You will go on the MCA website. You will try to go on the Run portal, try to find out the name, whether it's available or not. You will try to reserve the name. You will go at MCA level. So ROC, Registrar of Company or Ministry of Corporate Affairs, is the one who is centrally managing the formation of LLPs as well as corporations. So there is no central authority. There is all state authorities. So there are 50 states in the United States. All states have one type of authority, which is known as Secretary of State. For example, if I show you directly, so there will be a Secretary of State. So every state will have their own website. It's California Secretary of State. This is the name of the person who is holding the position as of now. But this is the authority which manages business, all the business. There is one same type of authority, Delaware. Delaware is the one of the most popular state where the companies are being incorporated. So Delaware is the most popular state as of now. Delaware Secretary of State. Every state will have Delaware Secretary of State, Delaware Division of Corporations. So Delaware has a division of corporation which is managed by the Secretary of State for entity formations. And whenever you will see a venture capital funded company, most companies are in Delaware. Even if you will find the parent company of Google, which is Alphabet, that is also being incorporated in Delaware. Even if you find some other, earlier Tesla INC was also into Delaware, but Elon Musk had some dispute with the Delaware authorities, so he shifted his company to Texas now. So the Tesla Inc. is now in Texas. But every state have, for example, if I go into Texas Secretary of State. Every state will have a Secretary of State, and the Secretary of State will manage the entity formation. You can understand it in such a similar fashion. Because there are states, Secretary of State is the supreme authority. Like in India, when we are into a state, governor is the supremo of a state. Governor is the supreme authority. There, the Secretary of State is the supreme authority. So whenever you are trying to deal with a company formation, you have to be very clear on the mindset that you have to choose a state. You have to decide on a state. Whether you want to open a company in Delaware, whether you want to open a company in Texas, whether you want to open a company in California, whether you want to open a company in New York. For example, if you talk about jewelry business people, they mostly focus on New York, because New York has the type of vibes which they need, and it is the arts, culture, and all those things. Many Indian big names from India are also being situated in New York for the purpose of doing businesses. So whether it's being X person or Y person, you can even find out through the Google that which big Indian brands, specifically clothing, accessories, and jewelry brands, are into United States, and you will find most of them are in New York, because the type of jurisdiction. The same way, if you find more IT companies will love to open in California due to Silicon Valley. Nowadays, Texas is getting more popular also. If you will see that if the peoples are backed up by venture capitalists, most of them would be having an office or a company formed in Delaware. So it depends which state gives you what type of advantage. So Delaware provides you high level of privacy. Delaware provides you high level of flexibility. That is why it is being more popular with the investors, because they get more comfort into Delaware state. There are other states also. For example, Wyoming is one of the most cheapest state for entity formation. They open a company in as low as, I think, $150. It is very low rate as compared to any other state. Depending upon the need, Wyoming is mostly preferred by e-commerce or drop shippers. For example, if you are into e-commerce business, or you are into drop shipping business, you will not prefer Delaware, because Delaware is no use. So you will try to go for a cheaper option. You will try to go with Wyoming. So it depends which type of entity, which type of business you are in, what type of state do you want to choose. When you are choosing a state, some consideration matter, whether you want funding, VC funding, which type of business you are into, what do you think of future aspect. So you would not wanting to go into a complicated state. And further, because there are 50 states, there are 50 company law, and there are 50 LLC acts, there are 50 partnership acts. So in US, there is no central law such as Indian Partnership Act 1932 or LLP Act 2008 or Companies Act 2013. Instead, when I talk about Delaware have Delaware General Corporation Law. Delaware is having this. When California Corporation Code, if I go, California will have a corporation code, and these are not similar. They all are different in nature. So if you see, there will be some certain provisions. If I open Delaware General Corporation Law, it will be having some different set of provisions. And so Delaware provides an authenticated PDF also. So technically it's just a 129-page law, and that too just a law. There are no separate rules. There are no separate Companies Act. For example, in India, we would be having Company Act 2013 rules also, but there is no rules in Delaware, at least. So when you are looking at a particular state, if you are thinking of opening a company, you should also be mindful that what type of corporate governance requirement does the law require. So for example, Delaware asks you for bare minimum corporate governance requirement. So they are not concerned. That is why the highest number of entities are opened into Delaware, because they offer such level of flexibility. Otherwise, if you go with California law is being a strict law. They will not allow you to do anything you want to do. They will have some certain code. They are having some certain provisions. You have to follow the provision. Here, sometimes you will also feel that where in Delaware, under Delaware General Corporation Law, if you have a bylaws is as good as memorandum of association and article of association. So at some places, Delaware law gives you a flexibility that whatever you have written in your bylaws as good as MOA, can overrule even the state law at a few places. So it can say that notwithstanding anything written in bylaws, if nothing is written in bylaws, then follow Title 8 Corporation. If there is something written in the bylaws, then you can follow bylaws, whether it is it is not mandatory that it has to be sync in with the corporation law. So this type of flexibility and advantages are available when you're talking about entity formation. And in United States, when you're talking about entity formation, it's an entire online process. So it does not mean that you have to visit US. You have to have a US office to start your own practice from the US. So for example, if I go Delaware, name, let us try to do this one. Delaware name reservation process. You don't need to do a name reservation. I'm just trying to show you an example. So it's an online website. Always use websites ending with .gov, as .gov.in is Indian domain, .gov is American. So they have the core domain .gov, post at .gov.au Australia, .gov.uk UK, United Kingdom, .in India. So this is an extension of the official .gov domains. So what you have to do, this is name reservation portal. For example, if you want to find out that whether a name is available or not, what you will do? It is the portal. There are 50 states that there are 50 portals. I'm just talking about Delaware because it is the most popular state. If you will find out the inquiries, the most inquiries will definitely come for Delaware. And post that, if you are talking to an e-commerce operator and some business who is a sole proprietorship, not very interested in VC and all those things, they will ask for Wyoming. So these two states are very heavily popular. If you are dealing in jewelry people, they will ask you for New York. And this is not at all information which is only available to me or anybody else. There are highly available, there are n number of videos which are available over YouTube who have taught that how to fill a form. So it's not a complicated exercise. Instead, it's a very basic exercise. At least if you are thinking of starting your own US practice, I always recommend everybody that at least start with US company formation, because it's an easiest thing to start with. So for example, here are the name of company. Here are the types of entity. You can open a corporation, you can open a trust, you can open a partnership, you can open an LLP, you can open an LLC, you can open a general partnership, you can go for a series LLC or LLC registered series or LLC limited partnership series LLC. There are some series LLC concept, LLC owned by LLC, owned by LLC, owned by LLC. The series LLC, specific structure for some certain registrations. Again, when you will be dealing in more complicated exercises, then you will come to these type of concepts also. But as a simple thing, for example, if somebody comes you for opening a corporation, then you have this type of endings. You can end your entity ending as association, company, corporation, corp, club, foundation, fund. So foundation, fund, society, union, these are normally non-profits or private clubs. For example, if there is a private club or a private foundation or public foundation, so you can also have your company ending with limited or LTD. It does not mean that India only have a limited or LTD ending. They also have. For example, Tesla INC could have been Tesla Limited also. It would have made no difference. But in US, INC is more popular or Corp is more popular. It shows directly the jurisdiction you are into. For example, if I say that counting tax INC, whether I am able to get this name, I'm just writing it randomly. So if you see, okay, let me do it again. GFC. So accounting tax INC is available. You can reserve this at $75. However, in US, you don't need to do this reservation because technically the names are not at a centralized level. For example, if you will see, this name can be available. For example, if I go, unless otherwise the name is trademarked or done everything. For example, if a person has the same name company in Delaware, you can see the same name company in California also owned by different person. So technically there is a possibility, unless otherwise you have a brand name or you have a trade name registered for that name. For example, if I do a trade name accounting tax, if I register this name, then it's mine and I can sue somebody. If it's not, I have not made a trademark for it, then technically you can find the same name in some other state and with different owner, not with the same owner, or not related to the owner, same owner. So this is the advantage also, and this is on some side it is also of a disadvantage that your name can be taken by somebody else also in some other state because you don't have a trademark of that name. But on the other hand, if you are facing some problem that okay, this name is taken but you want the same name, you can go to other state. Even if sometimes we make a strategy that if a client is For example, if a client wants to close a company in a particular state, but wants same name in some other state, there is an option of merger also. But sometimes client, due to some specific reason, don't want to do a merger of one state entity to another state entity. They will just try to close the old entity and start to open a new entity, but they don't want to change the name because of the value associated with that name. So that is sometimes a strategy also when you are dealing in practical life scenarios. So moving on to further, so there is partnership. I talked about sole proprietorship partnership, one or more two or more person coming together, and majorly they're coming for business purposes, sharing profit losses. Again, partnership is a pass-through taxation entity, and partnerships can be registered. Partnerships can be registered. For example, when I was showing you this, that what type of entity ending you can have, or what type of businesses you can register. So you can register these type of business also. You can register general partnership also. So when you register general partnership, as we have MCA 21 here in India, where you can go on a public portal and search private limited, limiteds and LLPs names on a public portal. So the same way we have here also. Already, all you have to do is just name that, just remember the word business entity search, and before that write state name. For example, if you want California business entity search, you want to do Delaware business entity search, Delaware business entity search, California. And I always told you that go to .gov website. These are official websites. There are many multiple websites. For example, if you want to find Google INC, if there is one. So Google is not an INC anymore. Google is an LLC now. So Google LLC, if let us assume that we are able to find Google LLC, here it is. You will face this problem that whenever you click on Delaware portal, it will throw you back, and then you have to do it. You have to research it again. You have to do the name search again, and then it will open. So yeah, Google LLC, it was open way back in 22nd October 2002. It's a Delaware company. The registered agent. So there is one person called as registered agent. As we have a concept here in India that you have to have a local director, there is a concept that you must have a registered agent. So who is the registered agent? There are not local directors. They are professional people. So they are professional companies. So you would say that it is not a individual name. It's a company name, corporation service company. So they offer services in $50, $100, $200, $300 per year. So it's a mandatory thing. Why this is required? Because technically, as US does not have any restriction on having shareholders from US only or partners from US only, you can even open a shareholder with a single company. So technically, you don't need to have two shareholders. You can have single shareholder. That single shareholder can be an officer also, can be a director also. Unlike India, where you have to have a minimum 2 directors. You don't need 2 directors. You don't need 2 shareholder. Only 1 shareholder is enough. Further, these people do not have any power with them. So they cannot decide anything for company or your corporation or your LLC. Just they are there to receive official notices. For example, if Delaware state wants to give you a notice, you are in India, you can say that I never received the notice. So who will receive the notice for your behalf? So what it is assumed that whenever there is some legal notice from department side or even from some entities, for example, if Mr. A wants to sue Mr. A wants to sue Google LLC. So what they can do, they can, if nothing is happening, they can just serve a notice to the registered agent, as well as they can serve the notice to Google LLC. Even if the Google LLC says that I did not receive the notice, registered agent is responsible that if they have received the notice, they will tell the client Google LLC that we have received a notice for you. You are our client. We are intimating you that please take necessary actions, so that whenever there is a notice from department or any customer or anybody, they are able to take so the notice is being delivered. It should not happen that somebody is saying that the notice was never delivered, this is not executable, this is void. So that does not happen in the US. You must have a registered agent. The registered agent is a company or an individual residing in state. Delaware registered, for example, this company is a Delaware company. That is why they have a Delaware address. It will not happen that a California address company or a California address individual will become a registered agent for a Delaware entity. It cannot happen. California entity will have a California people registered agent. Delaware entity will have a Delaware registered agent. But these services are mostly very cost effectively available on Google. You can just set registered agent services. We will find out these are available as low as $29 per year. So it's an yearly service. You have to take a subscription type of stuff. Whenever you will receive any notice, they will open the notice, scan a copy, and they will give it to you. If you want, they will also, if you want the scanned copy to your delivered to your physical address, you can pay them the postage charges. They will provide you the physical copy, they would deliver you through FedEx or USPS or UPS, whatever, depending upon the availability. So same way it's a partnership, the same way it's a corporation, C corporation, S corporation. C corporation are very basic structure. C corporation is a structure where you can see that private limited shareholder are separate, individuals are separate, or shareholder separate, or company is separate, and company is being taxed at the federal level. So company is being taxed at the rate of 21% in the US. There is a flat tax rate of 21% in the United States, and the company, whatever the profit they earn, if they want to distribute it to their shareholder, they can distribute it in form of dividend. Dividend is again taxed. So sometimes people say the C corporations are double taxed. They add one at the corporation level, one at the shareholders level. So as of now, the rate is 21%. It might decrease, it might increase, but as of now, it's flat 21%. Earlier, it used to be a slab rate, which was going to 37% also. Now, from 2017, last Trump administration, they made a flat 21%, and now it's not being into a consideration that they have this. LLCs, I already told you that these are hybrid structures, come into play for some advantages of partnership, some advantages of a corporation, and when you club together, they become an LLC. So partnership have a pass-through structure, LLC do have a pass-through structure, but on the same side, they have a protection, liability protection, which a company or a corporate offers. So corporate liability protection is at the topmost level. LLCs do offer that much, as well as the flexibility in terms of corporate governance and everything, because LLCs are governed by LLC Act, not Companies Act or Corporation Act. So they have flexibility in terms of corporate governance, having the partners in terms of taxation, vis-a-vis, but the liability protection is at the same level at the corporation. So now again, an important topic is entity classification election rules. So when we are talking about there is an election for possibility. So what does it mean by an election possibility? For example, if you are opening an LLC, LLC is a legal structure. LLC is formed under LLC Act, but there is no separate taxation structure provided under Internal Revenue Code. There is a code which is called as Internal Revenue Code, which is Income Tax Act. So this is a very good website provided by the Cornell University. This is a free open source website where you can entirely go through the bare act of the Internal Revenue Code. So there are multiple titles: A, B, C, D, F, G, H, I, J. A is for income tax. When you are talking about, so there are multiple chapters. So when you go on chapter number 1, so that chapter number 2 talks about self-employment income, which is subject to 15.3% tax. But if you want to know about all these things, so there are sub chapters. So when I was talking to you about that, there is a corporation called C corporation and S corporation. So why it's called a C corporation? Because the taxation is listed in subchapter C. So when you are talking about a corporation which is taxed under subchapter C, it's called a C corporation. When you're talking about a corporation which is taxed under subchapter S, it is called as S corporation. So there is a similarity. So why an S corporation is called an S corporation? Because it's taxed under subchapter S. And on the same side, if you go in LLC have multiple options. LLC can be taxed as a partnership, LLC can be taxed as a sole proprietorship, LLC can be taxed as a C corporation, LLC can be taxed as a S corporation also. So there are 4 practical availability for an LLC. So what an LLC has to do, the owners of the LLC, the members of the LLC, for example, if me and Kevin Bhai are LLC members, then we have to decide that what should be the classification of our LLC. And to make a classification, we have to use this form 8832. It's a very basic and fair form, only 2-pager form, or technically 3-pager form, but mostly you need to fill only 2 pages. So you just need to fill 2 pages, and 3rd page is only for late people who are filing it for late, and below that there are instructions. So every form in the United States have instructions. So there are instructions for each and every form. You don't have to wander here and there. You just have to read instruction, and instructions are very beautifully designed. They are events. For example, if I go here, line number, who must file, who have to file, when to file, where to file. Plus there are specific instructions. These are line item instruction. For example, if I go on line 1 or line 2, so you can refer to the form line number 1, type of election, line number 2, line number 2B. You will find step by step, line by line instructions. You can use this. So IRS has a very beautiful system of having publications as well as instruction. So whenever there is a form, there is an instruction. So if you are electing your own entity, you are filing either 8832, or there is another form called form 2553. 2553 is for S corporation election. 8832 is for corporation election, partnership election, or sole proprietor election, where you can find it here. a domestic entity electing to be classified as an association, taxable as a corporation, an eligible entity to be classified as a partnership, an eligible entity with single owner. So when you are a single owner, you are eligible to be classified as a disregarded entity or a sole proprietorship. So if I have an LLC with me only owner, I can choose it to be classified as a sole proprietorship. If me and Kevin Bhai are owner, we can decide it to be a partnership, or we can even decide it to be a corporation. It is up to us. There are several considerations to it. Definitely, whenever these sessions will go further, you will find out that what are the considerations to it. But there is a possibility, there is a flexibility. This type of flexibility you have to offer to your clients also. That okay, we can choose. For example, if a client is trying to open a LLC, then you can say that open an LLC, no issues, but make a tax classification which is a different tax classification. And normally this election, once you take an election, you cannot change it before 5-year period. So it's a 60-month rule. You cannot take it, and once there is a time to 75 days prior to the date of effective, whenever you want to have your election effective, but you have a 12-month time period also. And even if you're a late filer, you get 3 years 75 days. So you have 3 years time also, subject to certain condition. As I said you, if you are making a late classification, just go into the instruction. You will find out everything. What is the late classification election? What are the conditions? If each of the following requirement is met, you can make a late election classification. You can read this after this session also, whenever you get some time. Same way, there is an EIN number. You have to apply for an SS4. So it's a single page application, nothing complicated. So if you see this form SS4, it's a single page application. You just have to fill this application. This is an editable PDF. You can write it here. You have to write it. Just write the legal name. For example, if the legal name of the business is Accounting Tax Inc., you just have to write Accounting Tax Inc. I'm just using short names because of the time. But you can write mailing address. Mailing address can be of India because foreign address is acceptable. There is no restriction on having a US address when you are applying for a employer identification number in US. So you don't have to worry. Somebody says I cannot apply EIN because I don't have a US address. That is not right. You can apply for an EIN. Responsible party means who is going to be an officer for the entity. So for example, if I'm opening AT Inc., I will write my name, Manish Singh Sabharwal. If I don't have an SSN, ITIN or an EIN, I will write foreign. All these, how these are I'm getting, how this, it's everything written in, everything is written in the instructions. So this is a form. So not every form has the instruction below it. Some forms have different instruction. Form SS4, just type the form name and type the word instruction. You will get the instruction. It's very easy. So there are 6-page instruction. You can read the instruction. IRS is very kind enough that it also talks about that. What is the record keeping requirement, learning about the new law, or the form 42 minutes, preparing copy 52 minutes. They estimate a time. Again, in starting you will need more time, but as you go through it, you become a pro into it, then definitely it will even take less time what they are talking. So when you are a regular basis doer of this particular thing, EIN application does not take more than 20 to 25 minutes to prepare the application when you have all the forms with you. So you just have to write some certain names. You have to take type of entity. For example, if it's a corporation type, corporation 5 form 1120. So you just have to write 1120. If it's a partnership, just check on the partnership. If it's a sole proprietorship, check on sole proprietorship. Reason for applying, opening a new business. This is a valid reason, no issues with that. And each and every line item instruction. Again, one more thing just I want to tell you is that US have a flexibility closing, but the default tax year is December. So they follow a calendar year. They do not follow an accounting year like we have in India. A financial year is followed. They do not follow a financial year. They follow a calendar year. Plus these calendar year, you can see if you will see that there is a flexibility in choosing also. If you are opening a corporation, then you can choose your accounting year and as your own will. It's an automatically approval. So you can try it. You can end it in March. You can even end it in June. You can end it some. So I have seen even weird ending in February also. I've seen some ending in May also. So depending upon the need of the taxpayer, they can choose. But the condition is it has to be an INC. It cannot be a partnership. It cannot be an LLC. You have to be an INC incorporation to choose your own accounting year. Otherwise, you have to make a written application to the IRS to allow you to use a different accounting year apart from calendar year. This was about employer identification, and there are 3 types of TIN numbers: social security number, individual taxpayer identification number, and EIN number. EIN number is for businesses. Social security number is for US resident and US citizens. ITIN number is for like people you and me. For example, if I'm not a US citizen or a resident, but I still need a US PAN number because there has been some taxation obligation onto me, what I will do, I will apply for ITIN number. It is a non-resident alien tax SSN, a PAN number type of stuff. That I am a non-resident alien for US, I am applying a PAN number there, so it's called a ITIN number. It is applied in form W7. There is a separate form for it, and only authorized persons are allowed to make an application. I cannot make it directly to the IRS. I have to go through a certifying acceptance agent. So there is a person called CAA, certifying acceptance agent. I have to give it to them. They will verify my passport, and then an application will be made to them. A special consideration for Indian investors. So this is the last topic which we are trying to cover here today, and then Kevin Bhai will take over. So overseas investments and income tax at 1961 have a fair play in deciding. For example, if I and SP sir and Kevin Bhai, we three are coming together to form a venture, and if we are thinking of starting a US base. So for example, this applies to all of you. I'm just taking for example for the sake of simplicity. So for example, Mr. A and Mr. B are coming into partnership. After this lecture, you want to have a US company into place, which is really very good idea when you're trying to cater US clients. So what type of implication? For example, as an individual, Manit has to file a form FC, which is known as overseas direct investment, because I am bound by the Indian laws and regulation, because I am a citizen of India, I am a tax resident of India. I have to follow for Foreign Exchange Management Act. It says that I cannot invest in any foreign currency asset without being informing to in RBI. So I have to inform it to Reserve Bank of India that I am investing in a closely held entity. There are 2 types of investment. One is overseas direct investment and one is overseas portfolio investment. Portfolio investment does not require approval every time, or does not require even approval sometimes. However, overseas direct investment, when you are opening a closely held corporation, for example, you are opening an LLC, you are opening a partnership, you are opening a private, or you are opening an incorporation there in US or any other country, you have to follow this. So always try to be sure that, because this is a practical case scenario, we have seen that people open a US company, but they are unaware of the FEMA laws and the overseas investment laws, and the penalties are not quite insignificant. They are significant, as well as making the matter clear in RBI is a really time-taking task, and it is not that much easy thing also. So instead of making correction afterwards, do the filing in itself. So you have to do a form filing called Form FC. Form FC is a form which is provided by the RBI. You can find it. It's a freely available form, and whenever you go to bank, and RBI does not accept it directly. For example, there is a portal for FCGPR or filing some other requirements. RBI does not till date there is no online portal where you can prepare and submit this application. Instead, this application has to be submitted to the bank. For example, if you're using HDFC Bank, if you're using SBI, if you're using ICICI, these are called AD banks. These are called AD banks. You have to go to AD bank. Whichever bank you have account, you should have account with that bank, and then you have to file this Form FC, and the bank will ask you for many other requirements also. And along with the cumulative set, it will go around 30-40 pages of set. Then you have to submit it to RBI. AD Bank compliance team or Forex team will check that application. They will approve it. Once they will approve it, you will get a unique identification number for your US entity. That is relevant number, because this is one-time filing, and after that there is a filing called annual performance report, which is due every year on 31st December. So for example, if an entity had a closing year in 2024, must file its APR, annual performance report, with AD Bank RBI before 31st December 2025. So this is the legal requirement from India aspect. And again, not all type of entities are being allowed. So for example, you cannot open an unlimited liability entity as an Indian citizen or a resident in US. You are bound by the limited liability concept also by FEMA. You have to follow that also. On the other hand, if you talk about Income Tax Act 1961, whenever you are making a structuring for a person who is an Indian citizen, for example, money comes to you and you are my tax advisor for US tax purposes, I will come to you that I want to open a US entity. You tell me that open a partnership, because you are 2 people. It can be a daunting situation at the end of the day. Why? When it comes to US taxation, India will not, in India, partnership is a taxable entity. In US, partnership is a pass-through entity. So in US, no tax is paid by the partnership. Instead, partners are paying taxes. But in India, partnership does pay taxes. Partnerships are not subject to tax. Further, whether a US partnership is considered as a partnership for Indian income tax purposes, you have to check that also. As per my understanding, it is technically not, because it's a AOP BOI in India. And when you are talking about an AOP BOI in India, the taxation goes that all income has to be taxed in other sources or at maximum marginal rate if that AOP BOI has not paid taxes in India. So technically, you can end up at a very high tax rate, as well as if you are into losses. For example, if a US partnership was in losses, then what will happen? In other sources, you will not get a carry forward of losses to the next year. Versus if it would have been a PGBP income, you would have at least got a what do you say? If you got a carry forward to the next year at least. Further, US is a pass through. It does not mean that it pass through. It does not mean that it will entirely is business income. So, for example, if partnership is earning interest income, it passed through to you as interest income. If partnership is earning dividend income, it passes through to you as a share, as a partner, as interest income or dividend income or business income. So business income is taxed in PGBP, interest income is taxed in other sources, the dividend income is taxed in other sources, capital gain is taxed in capital gains for US tax purposes. But the same is not true for India tax purposes. You cannot apply US tax concepts to Indian tax concepts. When you are filing your India tax return, you cannot say that I will be using the same concepts I am using in United States, because there is no such provision in India which says that if a partnership is earning capital gain income, then partner is also assumed to have a capital gain income. Because in India, partnership is not a pass-through entity. Partnership is a taxable entity. So there is no such provision, corresponding provision exists in India. So you will end up paying very high rate of taxation, plus all your losses will be again wiped off again. And third thing, a item of capital gain can be taxed at a rate of 37% or 40% at the maximum marginal rate, whatever the rate it is. So we have to be very thorough in doing this type of consultancy at a time where there are Indian investors involved, at least for the time, for that particular period. So this was all from a holistic perspective. So when you're talking, to summarize, all these considerations are there. And the last thing, again, I missed one thing, which is bank account opening. So there is one thing called Mercury. I'm just showing Mercury bank account. This is a very feasible solution for all those people who want to have a virtual bank account from India. So if you open a US company, you want to have a US bank account, technically this is the best possible solution. In today's time, you can apply an application on Mercury. Mercury is not a bank. Mercury is a fintech platform backed up by 2-3 banks, Evolve Bank and Trust, Choice Financial Group, and one more bank. So what they will offer you, they will do KYC on the bank's behalf, and they will provide you a bank account, a proper bank account, but they do not have any physical branch. On the other hand, if you want to have a physical bank account, then you have to visit physically to the United States most of the time, and you can go there and you can have a KYC done at the branch level, and the branch will also open your bank account. You just have to verify your passport. But after the Trump administration has come into place, there has been higher level of restrictions. Banks are asking for social security number. You and I cannot have a social security number because of legal challenges. We are not US citizens and you are not US residents. But many at a place, for example, if you go to some bank or Bank of America or any other bank, there are some certain branches which are saying that we will not open an account if you don't have a social security number. Till now, Mercury and all those platforms are not asking for social security number. So till date, this platform is available, and you will get a bank account even in 3-4 days. That's not a big deal. And they are a bit liberal in giving bank accounts as of now. So to summarize all those discussions and all those things, I am heading towards giving the mic to Ankit ji. Ankit ji, can you please take this forward and
Yeah. Thank you very much, sir, for such an well-informed session. Your expertise, experience, and immense knowledge was completely visible from the same. Without any doubt, it will definitely help our members in their professional endeavors. Now, we will move on to our second session. I would like to invite our second eminent speaker, CA Kevin Rajgorji, who will share his expertise and knowledge about various US tax provision regarding different US entities, which was covered in previous session by Manish ji. CA Kevin Rajgor is a chartered accountant and US certified public accountant with over 4 years of experience in US taxation. He specializes in partnership taxation, high net worth individual returns, and real estate focused tax structures. He has worked extensively on federal and state compliance for Forms 1040, 1065, 1120, and 1120S, with a strong focus on clients in the financial services and real estate sectors. Currently, he is working as an independent consultant where he collaborates with US based clients on complex Indian and US tax matters. Over to you, sir.
Thank you, Ankit ji, for giving a brief introduction about me. So I'll proceed ahead. So good morning, good afternoon, and good evening to all of you joining from across different time zones. First of all, thank you for joining today's session and staying till now. It's a pleasure to be here with all of you today. I would also like to thank Manish ji for giving us such valuable insight in their earlier session. Now, usually what happens when most people hear US taxation, their first thought is usually, oh no, another system to memorize. But don't worry, I am not here to make you sound like an American tax lawyer. I'll keep it simple, relatable, and very relevant for us Indian CAs. As CA, we are all comfortable talking about Indian taxation. We can quickly explain how an NLP or company is taxed in India. But the moment we cross borders, especially to the US, the rules flip. And honestly, when clients ask us about US entities, sometimes our first instinct is not to answer them. So I'll try to make sure that after this session, we will be able to collaborate and answer all of the queries which we receive while dealing with our US clients. So let's dive in. And don't worry, I'll keep this session more like a T20 match and not a 5-day test series. So, so today's agenda will be understanding US taxation of entities like various taxation aspects like pass-through entity taxations, which is usually there for partnerships, S corps, how C corps are taxed. Thereafter, we'll compare India and US taxations for partnership and corporation entities, and thereafter we'll also understand how implications work for Indian investors when they invest in USA. We'll also cover some of the real life scenarios and thereafter we will go through the question and answer session. So first we will cover the partnership taxation. So Manit Bhai has already covered majority of part. So first of all, the basic thing that it is not a taxable entity, unlike India, as partnerships are also being taxed. Thereafter, the income which is earned by the partners that is not being taxed and it is being exempt. But this is not the case with US partnerships. The partnerships are not taxable entity out there in US and they are just a pass-through entity, just a vessel entity which flows the income to partners, and thereafter the partners pay tax by themselves by filing their individual tax returns. So partnership usually files form 1065, and so this 1065 form is a form which has to be filed by every partnership, and the due date for this form is 15th day of the third month from the end of the financial year. So as Maniji already specified that usually US has a calendar year. So if we see 15th day from the third month, then it comes to 15th March and 15th March and usually US entities get US entities or US for individuals, they get a 6-month extension which can be filed by filing a simple form out there. So after filing that simple form, their due date automatically gets extended by 6 months. So in case if it is a calendar year partnership, then the original due date is 15th of March. But if they file that extension form, then it will automatically get shifted to 15th of September. So, and we have to note here that the due date is 15th day of the third month from the end of the financial year. So, as Manish ji told that there can be entities which are having other than the calendar year as their financial year. So, once their financial year ends, from that we have to take 15th day of the third month, and that will be the due date for those partnerships. So, now partnership issues K1 to partners. So what is this K1 thing? So K1 is actually a supplementary form, a supplementary schedule kind of thing, which breaks down various incomes, various expenses, and it shows which partner it gives to each and every partners which are present in that partnership as a supplementary schedule, that these all were the income and expenses which were being received by partnership during that particular financial year. So this K1 is also itself filed along with the Form 1065. So the another aspect is that partners are taxed on profit whether distributed or not. So now we'll take an example like me and Maniji, we both agreed to file a partnership, ABC limited partnership. So in that case, we invested, and income was there was a profit generated by partnership of say around $100, and we both were 50% partners into that partnership. So the income generated by partnership was $100, and the share of me and Maniji were 50-50 each. Now, even if the partnership has not distributed that $50 to me or Maniji, then too that $50 will be taxable to us. That is the case in US taxation. So even though those profits are not distributed, then too those will be taxable to the individuals. So then it's like if we say that it's like if your friend has ordered a pizza and he ate all of it, and then after eating all of it, he sent you a bill for splitting the bill for the pizza. So even though you have not earned the income yet, then too you will be liable to pay tax on it. So here, small example is there that profit was of 100,000, 50,000 taxable to each partner. Even if no cash distributed, it is considered as phantom income, which says that the even if income is not being distributed to partner, then too it will be taxable to them during that particular year. So this was the case with regards to partnership taxation. And similar kind of thing, like there is one more entity who has the same pass-through scenario, which is S corporations. So S corporations is has similar uh, taxation as that of partnership, like the pass-through status, wherein uh, income will not be taxed at S corp level, but it will be distributed to partners, and partners will be taxed on the income generated by S corporation while filing their own individual returns. Now the due date for S corps are also same, like it is the 15th day of the third month from the end of the financial year. And similarly, they also get a 6-month automatic extension if they file a simple form, after which their due date gets extended by 6 months. So it's easy to so everyone will say that what's the main difference between a partnership and an S corp. So the main features of S corps are that only US residents can be shareholders, unlike partnership wherein each and everyone can be a shareholder. But in case of S corporations, only US residents can be shareholders, and no one other than US resident can be a shareholder in S corporation. So it sometimes restricts an Indian person to be a shareholder into the S corporations. So it is like for us Indians, it's like S corporation is like that an exclusive club in town where the bouncer doesn't even look at us. We always are. We always know that it exists, but we don't even bother standing in the line for those clubs. So another rule for the S corporation is that max 100 shareholders are there. Shareholders should be there in the S corporation. So there can't be more than 100 shareholders in S corporation. If it is more than 100 shareholders, then the S corp status will be ruled out. And accordingly, I said that Indian residents cannot invest in S corporations, as only US residents can be shareholders. So, and the taxability would be same as partnership, even if the income is not distributed by S corporations to their shareholders, then to that income will be taxed to the individuals during the same year. So we can compare that to India, like in an LLP or partnership, the firm where the firm pays tax of 30% plus, and the distribution is exempt. But in US, partnership and S corporations don't pay tax at their own level. They pass through income to the individuals by giving K1s, and thereafter, after receiving K1, the individual shows those incomes at their own individual tax return. So if pass-through avoids double taxation, so then why would anyone choose a C corporation? So we will see about that thing, that why C corporations are being also considered as a very big kind of thing for Indian persons. So C corporation is considered first of all, C corporate is considered as a separate taxpayer. It is being distinguished from the individual, so it pays tax at its own entity level itself, and the tax rate is 21%, as mentioned by Manit Bhai earlier. So a flat tax is being charged at 21% for C corporations on the profits being generated by them. Thereafter, when they pay dividends to their shareholders, then those dividends are again being taxed to their to the shareholders, which shareholders receive them. So when shareholders receive any dividends, that dividend they will have to show it in their individual income tax return, and the slab rate applicable to that individual will be taxed to those dividends again. So usually, if in that case also, if it is kind of a qualified dividend, then only a lower tax rates are applicable to them, and not the actual slabs which are there to the individuals. So here also we will take an example, like 100,000 profit was there. If we take 21%, then 21,000 tax was being paid by corporations at corporate level itself. Then we were remaining with 79,000 as our income, and that whole 79,000 was being given to individuals as dividends. So if we consider these dividends as qualified dividends, then qualified dividends are usually taxed at 0, 15, or 20%. So those will be taxed according to their income levels to the US individuals. And if it is an Indian shareholder, then withholding will be applied to them. Usually the withholding is 30% for non-resident shareholders in US. But as we have DTAA with India and US, so in that case, if the Indian shareholder has more than 10% shareholding in US corporation, then the holding will be limited to 15%. So here, as 79,000 is being given as dividend to Indian shareholders, and we are considering Indian shareholder as more than 10% shareholder into the US corporation. So 15% rate will be applied, and therefore 12,000 is the US withholding, which will be done on the dividend which will be given by C corporation to Indian shareholder. Therefore, net 67,000 will net 67,000 would only be received by the Indian shareholders. So it is kind of double taxation. And thereafter, this is also an example entity. It is the same example. Entity earns 100K, entity pays 21 tax, 21% tax, dividend is distributed. Thereafter, shareholder will pay tax again at their individual income tax. So now let's come. So this was the thing regarding C corporations, wherein which they consist of double taxation. Usually we professionals say it as double taxations, but clients always consider them as a double tension. So now we will compare the Indian partnerships with US partnerships and see what are the distributions in them. So first of all, India partnership firm pays a tax at 30% plus surcharge or cess whatever that may be applicable. Thereafter, whatever distributions which are there to partners that are tax free. But in US, as we discussed, as partnerships are passed through entities, therefore no tax will be applied at their entity level, and then the amount which is being earned by a partnership that will be given to partners with partners via K1, and with that K1, the partners will be taxed directly on their individual tax return. Regards to compliance in India, we file ITR 5 for filing Indian partnership tax return, and in US partnerships, we file Form 1065 plus K1. So this was the major difference between India and US partnerships. Now we will go to India and US corporations. So if we see that, then there is no much kind of differences between taxation of corporations between India and US. So the thing is that Indian companies are usually taxed at 22 to 30%. Some of them also have some good exemptions if the criteria that are met, and they are also taxed at 15%, while USC corporations are taxed flat at 21 percentage. We also saw that for Indian company, we know that dividend is taxable to shareholder. Earlier there was DDT, but now it has been abolished. So that's kind of a relief to shareholders. And thereafter, regards to dividends in US C corporations, dividends are again same taxable to the hands of shareholders, and there was never any concept of DDT. So it's just that dividend is taxable to the shareholders, and the withholding is 30% if in case any Indian shareholder is there into a USC corporation, and if as per DTAA between USA and India, those dividends are taxable at 15% if shareholding is more than 10%. So now what if shareholding is less than 10%? If shareholding is less than 10%, then this withholding comes to 25%. And in India, the withholding is usually applicable at 10% if in case any dividends are being given to foreign shareholders who are shareholders in Indian corporation. So these were some of the differences which were there into India and US corporations. Now we will jump into uh, uh, some scenarios which we will take. So what happens when an Indian resident invests in US partnership? We will take one example, like Indian partner is investing in a US partnership. So in that case, if an Indian resident is a partner in a US partnership, then the partnership files Form 1065 and will issue a Schedule K1 showing income allocation to that Indian partner. Thereafter, that Indian partner will be taxable on the US, taxable in US on that share of income, regardless of whether that income was distributed to that Indian partner or not. Thereafter, the US partnership will also withhold taxes in advance, as the partner is a non-US partner. Therefore, that withholding will be at 37%, and the share of income will be usually treated as ECI, which is effectively connected income. So these are the incomes which are generated from doing business in US. So hence it will be taxable in US itself, and as it is an Indian partner, hence US withholding will be done at 37% in this case for the Indian partner. Thereafter, the same income will be taxable again to that partner in India also, but thereafter relief will be available via the Indian US DTAA, and hence they will be able to take foreign tax credit by while filing his income tax return in India. So, for example, we will take he is getting 50,000 share, 18,500 withheld, 37%. Thereafter, he will have to report the full 50,000 in India, and thereafter claim the foreign tax credit which was being paid in Indian income tax return. So now we will look at a shareholder. So this is again the Indian partner in US partnership. US partnership will give profit allocation to the Indian shareholder. Indian shareholders' profit will be withheld by US persons, and thereafter, Indian partner will have to show the full income in India while filing his tax return, and thereafter he can claim FTC of the same. So now we will look after what happens when an Indian shareholder is invested in a US C corp. So if an Indian shareholder has been invested in a US C corp, then we know that US C corps are taxed at flat 21% of rate. Thereafter, once they are being taxed, thereafter when they give dividend, so that dividends are usually subject to withholding of 30%. But as we discussed earlier, that if Indian shareholder is more than if Indian shareholder is holding more than 10 percentage in any USC corp, then that withholding will come down to 15 percentage. And if it is less than 10%, then it will go up to 25 percentage of US withholding. And so this is the case. And in India, then in India, the dividend is taxable, and then foreign FTC can be claimed for same thing. And he won't get any credit for corporate level tax. The 21% flat, which would have been charged to the US corporation, that 21%, the Indian shareholder would not get any credit for that 21 percentage tax. So, for an example, we will take 100K of dividend is there. So, 15,000 of US tax will be withholded by the US corp before giving dividend, and thereafter in India, that Indian shareholder will have to report the whole 100K and thereafter claim the FTC while filing the Indian tax return. So now we will again see this thing. The US corp will pay 21% tax at entity level itself. Thereafter, it will distribute dividend to Indian shareholder. While distributing dividend, he will reduce the withholding and pay the amount to the Indian shareholder. Thereafter, Indian shareholder will, while filing his own personal tax return, he will report the gross income in India and thereafter claim FTC for the US withholding done by the US shareholder. Now we will go and check some of the real life scenarios wherein I've taken some 3-4 scenarios and we'll discuss upon those scenarios. So first thing is startup founders in India set up a Delaware C corporation. So usually we see that the VC funding, venture capitalists who are funding, they always suggest that you should have a C corporation out here in US. Thereafter only we will be doing the fundings to your ideas. Therefore, what happens is usually people set up a C corporations and thereafter they receive the funding from US personnel. And as Manit Bhai said that, yeah, Delaware is always, you can say, a gem of a kind for anyone developing a C corporation, as it is there are very much benefits of incorporating C corporation into Delaware. So yeah, in this scenario, we will take one example like let's say that there are 3 friends from Bangalore and they have started an IT startup, and an American venture capitalist told them that we will invest into your startup of around $5 to $10 million. But the thing is that only if you have C corporation into a Delaware or any other state, then in that case, these Indian guys, they set up a C corporation into Delaware. Thereafter, that Delaware entity will be liable for a 21% corporate tax rate, which we discussed earlier. later on, whenever that C corporation would send any dividend back to those three friends, then that dividend amount will be with first that from that dividend amount first taxes will be withholded by that Delaware C corp of around 15 to 25%, and thereafter the net amount will be provided to the Indian shareholders who have incorporated the C corporation into US. So founders need to plan very carefully. Otherwise, by the time profits reach India, a large chunk already goes out into US withholdings. So that is one thing which they have to plan out before doing any such kind of setup. So a second scenario which we have taken here is like an Indian CA firm invests in US partnership. So what will be the case if such a situation is there? So here also we will take an example. Let's say uh, there is one CA firm, a CA firm in Ahmedabad, and they decide to diversify their portfolio, and they decide to make investments in US also. Then they invest around to let's assume around 200,000 in a US accounting tech partnership firm. Then what will be the taxation in that case? So the taxation will be such that in the first year they are allocated as they have invested in partnership, and we know that partnership is a pass-through entity. So tax will not be levied at partnership level, but it will be carry forwarded to the individual level, and thereafter individual will have to pay taxes on them. Even and they will have to pay. They will have to show the income from partnership, even if the partnership has not distributed those income to the partners. So in this case, let's assume that the US partnership had profit of around $40,000. So even though the firm did not, even if the Ahmedabad firm did not received even a single dollar in cash, then too US will you will have to show income of 40,000, and taxes will have to be paid on that 40,000. And in when we look after what will happen in India, so that same 40,000 will be taxable to the Indian CA firm in India itself, and thereafter they will have to take a FTC under the India-US tax treaty for the amount which amount of share profit from the US partnership firm. So after hearing this thing that even if I've not received even a single dollar from partnership, then too it is being taxed. Usually clients get surprised that we didn't get any distribution. Why are we paid tax? But under partnership taxation, tax liability flows through whether or not cash is distributed by the US partnership. Now we will take one more example where an Indian HNI invests via LLC, which is being taxed as partnership. So we Indians are always in love with real estates, and the demand for taking or investing in real estates outside India has also been started booming out. So we will assume here that one of the Indian HNIs is purchasing is investing into US real estate. US real estate. So we'll assume that he is investing around $500,000 in a Florida property via an LLC. So the LLC is treated as partnership. So as per the IRS, the property manager who is managing that property would have to withhold 37% of tax on the rental income which is allocated to that Indian partner. So if we assume that that rental partnership had made around $100,000 of income or profit during that year, then after from that $100,000, 37% would be withheld, which will be around $37,000, and thereafter the net will be remitted to the Indian HNI. So thereafter, when HNI will finally file uh, the tax return in India, that time he can take FTC of the taxes which were being paid by him in US. And also we can see that the withholding was being done at 37%. But there can also be a case that that Indian HNI is not being liable to pay 37% while he's filing his US income tax return itself. So if he comes under, say, around 17% slab, then only 17% will be taxable to him, and the excess of 20% will be refunded back to him while filing his US tax return. So this is why when the HNI, this is why when withholding planning is crucial to be done while doing any kind of such setups. Otherwise, clients feel that they have lost a lot of money to IRS, wherein they actually have not, because withholding percentage was 37%, not the actual tax rate which was applicable to that person while filing the US tax return. So now we will go to the fourth scenario which we have taken. So this is the scenario wherein an Indian parent company is receiving dividend from US corporation. So now we will take a corporate example wherein an Indian company owns 25% of US subsidiary. Then the US subsidiary distributes $1 million as dividend to the Indian company. So before giving dividend, they will withhold 25% of it won't be 25, it will be only 15% as the Indian company is holding more than 10% into a US subsidiary. So they will be withholding only 15%. Thereafter, the Indian parent would pay Indian corporate tax, say 30% on the full $1 million. Thereafter, the Indian parent can claim foreign tax credit of for the withholding or the actual tax which was being paid in the US for them. So accordingly, we can make any FTC planning for them. So these real life scenarios and examples show how global structures directly impact tax liabilities. And as Indian CS, our role is to ensure our clients don't just look at returns, but also at tax leakages across borders. So that was heavy, but let's simplify and look at some key takeaways. So we said that in US, a partnership are treated as transparent entities. That means the partnership itself doesn't pay any tax. Instead, profits are allocated to each partner and taxed in their hands, whether or not they had received any cash or not. And we had took an example that if an Indian CA firm invests in US partnership and US allocates 50,000 of profit, then the IRS expects tax immediately by withholding, even if the firm hasn't received any dollar yet. It still has to file and pay. So this is usually very different from how we think in India, where taxation is tied more to actual receipts. Thereafter, we went through C corporations. So C corporations are different than the pass-through entities. They pay corporate tax in the US itself, currently at flat 21%. And when they distribute dividends, shareholders again pay tax, often with withholding for shareholders. That's the double taxation rule, which we say. So we took of an example like an Indian HNI is investing in US C Corp, who would see 21% corporate tax rate plus 30% of dividend, 37% of dividend on their withholding. So, which uh, 37% of dividend withholding, but there is also it is also uh, important to note that if a startup in Silicon Valley, usually when and Indians are looking for any funding in Silicon Valley, then they always suggest that the Indian entity should have a US corporation in US itself, and majorly, yeah, they want it in Delaware as it is very much friendly in taxation and other operational things. So the third thing which we saw was differences in Indian and US uh, partnerships and C corporations. The way entities are taxed in India versus the US can lead to major mismatches. Like in India, partnerships pay tax at entity level, whereas in US, partnerships are transparent. This creates timing issues, FTC issues, and sometimes double taxation if we don't structure it carefully. Thereafter, we also saw that uh, always check DTAA and FTC when structuring investments. So, as our advisors, as we are advisors, so we should always never structure without checking the India US DTAA and foreign tax credit mechanisms. Otherwise, clients could lose around 30 to 40% of profits just because of these leakages. So, in this case, we took an example of an Indian company which received dividend from USC corporation. It can claim FTC in India for the US tax which has been actually paid by him in US. And but if an Indian investor is in but if an Indian investor is in US partnership, then claiming FTC can get tricky due to a year mismatch between India as it has March and April financial year and US follows calendar financial year. Calendar as their tax financial year. So the DTAA and FTC provisions are like the main thing to check before giving any cross border suggestions to her clients. So this was majorly all of it. So, and this will bring to our end, and I'll just uh, give one closing that Indian tax is like a cricket thing. As we know rules, and we have already watched it and played it so much of time. Hence, we find it very easy. But US tax is like baseball kind of thing. It looks confusing at first, but once we have understand the rules, we can actually hit a home run for all of our clients. And I think and I hope that we all will be ready to play both these games now. And lastly, I would also like to thank our committee for this chance. Ashish sir, SP Singh sir, Aparna ma'am, Prachi ma'am, Manish ji, Ankit ji, everyone for giving this opportunity and conducting this such a great uh, webinar. I'll hand it over to Ankit ji for further. Thank you.
Thank you very much, sir. We want to express our sincere gratitude for your enriching session. Your expertise and insights not only captivated our participants, but also provided an invaluable knowledge that will definitely benefit us in our professional endeavors. Now, we will move on to our last session, that is Q&A session. We have a Q&A session. We are quite confident that our speakers will thoroughly address all your queries and doubts, subject to the availability of time. So now we are moving to our quick Q&A session. First and foremost question is, can the Indian parent own 100% of the US subsidiary, or do we need a US shareholder?
So technically, if you talk about this, so there is no restriction. A Indian parent can have a 100% wholly owned subsidiary, which is perfectly fine. And this model is specifically used by many entities already. So no issues with it.
Okay. Thank you, sir. Our second query is, what common mistakes do Indian investors make when setting up in the US?
So I'll take the entity part, and then there will be some tax part which will be Kevin Bhai will take care of. So normally the first mistake, normally what they do is sometimes not just following some advice through the in unorganized channel. For example, they go on Google and then check. So they will get a recommendation that you go and open an LLC. Sometimes they will think that they are also eligible to open an S corporation. The first and foremost mistake is that have an entity structure into place, keeping in mind both India laws as well as US laws. It's just not US laws, it's just not India laws, both the laws are required. The second thing which they make a mistake is that they are usually, we have seen that they are not aware of the compliance requirements. So once the company is open, they start. So for example, they have done everything to come into operational phase, but they don't know that these are the requirements. For example, here in India, if you are doing MCA compliances, MGT 14, AOC 4, or XYZ compliances, so there are also annual compliances which are need to be done to keep your entity active. So many a times investors or the founders do a mistake very frequently that they don't do this. Plus, they also forget that the tax return is also a mandatory thing in the US, which you have to file. It does not mean that you did not operate it. It does not mean that you are exempt from filing a return when it's a corporation or a partnership or an LLC. It has to be a nil return, but it has to be filed. So and when there are foreign shareholders, at least foreign partners involved, so there are withholding requirements which usually people miss. They file a return from US partnership, but they do not file a return of the partners, which is a mandatory requirement when it's a partnership. And S corporation is not an option available. So this is practically, even if you elect, that is not allowed because you cannot write a social security number over there. So these were some mistakes from the this aspect. For example, and then one more thing, that FEMA aspect. Many investor, for example, individual investor do think that they don't need to do FEMA because it does not apply to them. But there is no threshold for FEMA. You have to do it. As well as there is a transfer pricing requirement if there are international related party transaction between your parent subsidiary, or you are an owner and you are even doing a transaction with your US entity, you are very well covered by the Transfer Pricing Act, the Transfer Pricing section here in India under Income Tax Act. At least you should file a 3CEB even if you are not getting a transfer pricing study done. And apart from it, taxation aspect, I think Kevin bhai, your expertise will be required.
So regarding taxability, we usually see that people withholding has already been done on the entity level side by the US corporations or US partnerships. Thereafter, we actually have to file tax returns in US itself for individual level itself, especially for partnership, as the income is ECI level income. Hence, when we file a partnership in at individual level in US, that time we have to see that the rates which are applicable to us. um we pay taxes according to those rates only and claim the excess refund regards to excess withholding, which had been done by the US partnerships. And thereafter, while filing Indian tax return, also we take the FTC of the actual taxes which were being paid by us while filing US tax returns.
Thank you, sir, for such detailed explanation. Now we'll move on to our next question. How to open a proprietorship company in US by an Indian entrepreneurship?
Technically, as I mentioned at the time of the session also, so having a sole proprietorship is very easy. You just decide a name and you have to obtain a an employer identification number. You can just file a EIN number. You will have an EIN number. Now you are eligible to do business there also. There is no certificate of incorporation formation as you, but if you are trying to open a sole proprietorship, I'll recommend you, please do not expose yourself to all the liabilities. Instead, open a single member LLC or a single owner C corporation, which is you will be able to at least cover your personal liabilities in case something happens, somebody sues you. It's not a taxation aspect, it's a legal aspect, and it's a business understanding and a business sense thing, that at least you are not exposed yourself to legal cases or legal issues. Somebody cannot sue you directly, instead they are suing your LLC or your corporation. At least provides you a shield, unless otherwise you have done some fraudulent activity. So yeah, simple thing, just apply for an employer identification number, your sole proprietorship is in place.
Okay, sir. Thank you very much. Now we'll move on to next question. How do we repatriate profits back to India?
I think Kevin
Nice.
bhai,
Yeah.
okay, should I be answering? So Kevin bhai, if you want, then you can answer. Repatriation of profits back to India.
Yeah,
Sir, you are on mute. Audible.
Yeah, I'll go ahead with it. So repatriation of profits into India. So as we know that there are LRS schemes available. So based on LRS also, we can remit around 250K USD per year from India to US. And vice versa. So these are the ways which we can like repatriate profits.
Yeah,
Manish,
and
would
I
you
think
like to?
yeah, I will also add a few things. So, for example, dividend distribution, as already said, is a one option, but it's a taxable option. Apart from that, if, for example, let us assume I am an owner of my C corporation in the US, and I am also providing services to the corporation because I haven't, for example, if I would have not been doing it, I would have been hiring somebody to do this service. So, if there is a reasonable uh, contractor payments which can be established into between, because I am serving as the incapacity of a contractor also, though I can be an employee also. Or if somebody from my relatives are being as a contractor, I can even hire contractor outside United States in my US entity who can provide services, and I can pay them payments in form of independent contractor services, which is an expense for US entity, as well as this will be an income for them in India. So there will be no double taxation because US is not going to tax you, because under income India US tax treaty, it is covered that wherever the personal services are rendered, the taxability will happen in that country. For example, if Ankit ji or I am rendering services from India, services will be treated as sourced in India, and we will be offered to tax in India. We don't need to offer it to US, though it has been paid by the US entity. So one more way could be that you can structure it such a way that hire people in India. Don't make them employees because there can be some immigration issues, but you can at least make them contractors and make them payments to India. That is also a good way to repatriate without having dividend taxation issue.
Okay, thank you very much, sir. Detailed elaboration. Now, due to the time constraint, limitations of time, will not be able to take further questions. So now, before we draw this webinar to a close, I would like to invite IRS SP Singh Sarji to deliver concluding remarks and expressing our gratitude to all the participants. Over to you, sir.
Thank you, Ankit. It has been very, very enlightening session, and which, as I expected, I've been knowing Maneet and Kevin, their knowledge and expertise. The way Maneet has gone through the various entities through which the business can be carried out in US, and their implications and the way to set them up was very, very elaborate and made in a very simplistic manner. I think it must be very clear to everybody. And Kevin has gone on to explain the taxation. And the best part, which I liked, was that he took up five, live cases, scenarios, and dealt with very diverse, areas to cover almost all the gamuts of taxation in context of US. It not only made the thing simple, but it brought it closer to the audience. They can identify themselves with the various structures. It was a very nice initiative and very good way of presenting the thing. I'm sure people have been enlightened on many aspects of US taxation, because, as Manit said, that when you are thinking of opening a business in US, it is not only the federal, thing which you have to take into account, but you have to take into account various state laws also, because in respect of entities as well as taxation, different states have different statutes and a way to deal with them. Sorry. That makes, US taxation on running the business in US a complex one, but very interesting one. And I'm sure, all this, the description and the explanation which have been provided by both of them must have cleared several cobwebs for the audience. I would like to thank Sanjay ji for opening this, giving a very brief path which this series is going to follow. We had one session, and this is the second one, and we will have the sessions to follow in future, where different issues will be taken up, and which will be very beneficial to the audience. I will like to thank the staff of the committee who have under Aparna, who have ensured that the webcast is done in a very, very smooth manner, without any hiccups. The only I was absent visually for some time, It's very informative session. I thank everybody, both Kevin, Maneet, and most important Ankit, who was the sutradhar of this session. I mean, conducted it very nicely and in a very efficient way, and keeping the time in his mind. Thank you, Ankit.
Thank you, sir.
Thanks,
Thank you, sir.
Maneet and Kevin, and thanks everybody.
Thank you. So we are wrapping up. Thank you very much.
Thank you.
Yes.
Thank you very much.
Thank you, everyone.
Thank you.
Thank you very much.
Bye. Bye.
Bye.
Bye.
Bye.